Hey legends, I've just got finished uploading and editing a video with me and a student called Lance Moore. If you've been hanging around the Discord, you'll know Lance. He always posts his pre-market analysis. We did a little interview talking about why sometimes our backtesting data doesn't always match our live trading results. Make sure you go check that out, especially if you are struggling a little bit with your backtesting. So we're going to get straight into that now. Hey legends, how's it going? I'm just jumping on a quick call here with Lance Moore, where he's very kindly offered to go take us through some of his backtesting results. We had a couple of people in the Discord asking whether or not our backtesting results are often different to what our actual live trading setups are. There's a few unconscious biases that people kind of fall into when they are doing the backtesting. So I wanted to go through it all. We'll work it all out together while your backtesting results may be slightly skewed compared to what actually happens on the live charts. There's probably one of a few things that's happening here. So we're going to dig straight into it. Lance, if you wouldn't mind just taking me through some of the positions that you've backtested and then take me through some of the live positions that you've taken that don't quite match up the same when the criteria looks to be all the same.
Yeah, basically with my back testing, so I'll do the full thing, go to my 1 minute chart and go back as far as I can with it. So for this one here, I've done some back testing onto these two, which was Wednesday and Thursday of April, the 5th of April and the 6th of April. Basically, if we're going to a smaller time chart, as I'm back testing them, I can pick the areas of where they're going to, but in different areas sort of thing. Hang on, let me just replay that.
Yeah, sometimes you might not get the 1 minute data so far back. You've only got, I think, 10,000 candles on the 1 minute chart.
Yeah.
Perfect.
So let's say I'm here, and as I'm coming through, I can start to pick where they are on my charts. Sorry, I'm on a laptop, so it's a little hard to see.
Yeah, it's okay.
And as I'm coming to the area, I can sort of pick it. This one here, I've got that one as a different color because it's one that I've missed, and I'm just curious on how it would have played out if I did enter in a section. So that one there probably was come back as a loss.
Yep. So you mark that one in a different color because that's a no man's land trade. It's away from the IDFT. Is that right?
Yeah, but I did pick an equal low here to a point where it's reacted from, and it's got like a little bit of a support area.
Got you.
Yeah, so that's where I've been looking around this area because that is quite a large area in between. Sorry.
Got you. Yeah. The price is going to come down to a lower IDFT for that.
Yeah. So coming back to around these sort of areas, I'm picking while I'm doing this to where they're actually reacting from. And there's different time frames of how it's reacting to it. But then when I go to live trading, it just doesn't seem to work out.
Yeah, yeah. So what you could be happening is that as you're scrolling back to this area to do your back testing, you've already got like an unconscious bias. You've seen where price goes from this point, and yes, you don't know the specifics of what the candles look like and stuff like that, but you've already got in your head that you know that price is coming down, which is kind of like the main problem that people fall into with back testing is they'll see where price ends up going and then try and fit the criteria to where price ended up going, rather than trading it as in they're in a live setting. So what I usually do when I come to do my back testing is there's one or two things that I actually like to do. The first thing is to like squash the candles down so they're super small. If you grab the bar on the right and kind of scroll where the price numbers are, you can get them down so it looks like a perfectly flat line.
Like that.
And now you can't see where price is or what price did or what it did. This is where it kind of helps to be on the higher pro plan because you can go back even further and then you've got even like less memorable data. That's where I would put the replay tool on. Is I would find the point where I want to backtest, put the replay tool on there, and that eliminates any unconscious bias. The main problem that people tend to have with backtesting is they'll see price come down and then they'll look at the criteria of why price came down, which is important. But then it's more so they try and get their position tool on to say, this is a win, this is a win, this is a win. If you find that your back testing has, like I say, like a 90% win rate, but your actual live trading is like 50% win rate, you're probably falling into this kind of unconscious bias where you know where price is going to go. You're just trying to like make the story make sense of, oh, I would have ended here, and then price ended up going down, rather than being like, this is the position, and then moving on there without knowing what's going to happen. But it's good that you took the first position on, which went to, was it break even or -1, that first one that you took in no man's land?
The first one that it was like a more of a curious sort of entry looking sort of one that I
Yeah.
threw on there because I would have been, because where it come down to here, if we go back to the 1 minute, where it come down here, I was already about here. I'm going, I wonder what would happen because it looked like it was about to break the bottom. So I thought, okay, I'll tuck this one on, knowing that I didn't take that position, but I would like to see what happened.
Yeah, got it. So you kind of did that one retrospectively after it had already started to move down a little bit.
Yes, yeah.
Yeah. So it's important to note that, like, make a note of what you're actually backtesting. I probably wouldn't put them on the same charts like this because it will get confusing. You want to know roughly how profitable you can be in a week, what the average is, how far things tend to run, how big your average stop loss is. The more notes that you can make, the better. If you are going to backtest something differently, take a whole new page in your diary or open up a new Excel sheet, test it slightly different, and then combine the two. When I backtest, I go into specifically backtest one type of entry. I'm either looking for a rejection from an IDFT, a break and retest of an IDFT, a no man's land trade, but all the backtesting is on different sheets. It's all on different Word documents. It's all on different journals. However you like to record your backtesting, I'd probably make sure that it's separate so you know exactly what you're testing. I would the way that I would approach it would be to test one specific entry, get perfect at that entry. When you're live trading, you already know, the win rate of that entry, you know what to look for. You get really good at looking at that one. And then you look for a different type of entry. Maybe you look for a break and retest of an IDFT rather than rejection than what we've got here. You make a note of if you've got a break structure on the 1 minute, what the 5 minute was looking like, the 10 minute, the 15 minute, all that. The more amount of detail you can draw, all you're doing is basically collecting data. The more data you can collect, the more you can compare, the more you can realize what's working, what gives you a higher win percent. I know if I see this and this, then I've got about a, say, 70% chance that price is going to run to 1 to 4 and maybe a 50% chance that it's going to run to 1 to 6. So you can kind of adjust it and target more appropriately from there. One thing that I don't see here, and I don't know how you record your backtesting, but do you record all the entry criteria that you're looking at and all the specifics of it?
I do write down in a book the positions to take, why I've taken them, and if they're winners, losers, and how many pips and all that sort of stuff into a notepad sort of thing. I have previously chucked them into an Excel sheet to try and match everything up, but with work and time constraints, I haven't really been keeping that up too often.
Yeah.
But at least if I have it in a notebook, I can look at something.
Yeah. And is all your backtesting done with the same size stop loss?
No, that one there's a 4 stop loss and a 16 take profit first. And I think I've had a couple of different ones. I think that one was a little bit
So what's
different again.
Talk me through the criteria for your stop loss. Why is your stop loss where it is?
I try to hit the back of this one here. I didn't want to go more than 4 pips because of the massive move down. So if I was going to go any further down than that, it'd probably be nearly 6 pip stop loss, and that'd be a massive entry to where it actually needed to be. So that's why I've kept that one a little bit shorter to increase the probability downwards. For these ones here, I didn't want to go further down than the IDFP underneath from that support line.
Yeah, okay. And how would you kind of, I guess, write that as a rule for yourself, what the data is telling you? Like, what would your rule be for having a 6 pip stop loss or a 4 pip stop loss?
I'd rather just have a 4 pip stop loss and keep it as small, no more than 5.
Okay. What I'm asking is, what market conditions would, if you're not always going to use a standard 4 pip stop loss, which is one way of doing it, you can do that. But if it's going to change, sometimes you said there that you had a 4.5 pip, sometimes you had a 4 pip. What are the market conditions that would determine like that difference for you? Do you know what I mean? Because the standard way of doing it is to just take the last 1 minute candle or the last 2 minute candle, put your stop loss above there, and then your 4 to 1 and your 6 to 1 is kind of dynamic depending on where you stop loss.
Yeah. Oh, okay, yeah. It's similar to that, where if this wasn't a late entry, it would have been here and would have been at the back of that candle there. I'm guessing that's what I've probably would have done in that sort of scenario if I actually caught this down, but I didn't want to take it until it was broken this. So I've just gone to down to whatever this is, but a little bit shorter and try to keep it to the as short as I can. But back of any sort of structure or anything would be for me would be a good place. If it breaks that structure, then then I know that's going to go the other way.
Yeah. So what I would do would be to decide on concrete rules for your stop loss. Is it going at the swing high? Is it going to be stuck at 4 pips? Is it going to be the swing high if it's less than 5 pips? If not, the 5 pips is your maximum. Having like really consistent stop loss sizes is going to tell you like where you can and you can't target. Because at the end of the day, the biggest thing that you're trying to do is to just eliminate bad trades. That's all you're trying to do as a trader, really. Most people can identify setups when they're good. The problem comes is that they take too many losses along the way to get those setups. So having like standardized rules so you really like know specifically what you are testing and how you would execute that, and then going forwards into the trading a live account or trading a demo account, whatever stage that you're on in your kind of trading journey, you know that this rule is the rule that you're going to stick to. For example, I think Jay enters very early. He stop loss at the swing high, the previous 1 minute swing high, and then moves to break even at a specific point and moves its stop loss to half at a very specific point. Having that amount, whether it's not like 2 units you go break even, whether your stop loss is always this size, it's super important to know what you're testing. That could be one thing that kind of gives you disparity between your results. Because if you take this as this is where you're back testing, you've waited for the break of structure on the 1 minute, you've waited for price to break down out the IDP, which is all correct. That's all like fantastic stuff. The kind of difference could be that on your back testing you've got a 4 pip stop loss, but when it comes to the live market, that would have been a 5 pip stop loss and you wouldn't have got to 2 units and then went break even. So that's definitely something that I would try. Do you want to play through some of these candles and we'll have a look at some of your other positions that you back tested over these couple of days?
Yeah.
Something else that I just as well, mate, is your trading times. Do they line up with the times that you normally are at the chart trading?
Yeah, it's a little bit sporadic. So 1400 to 2 o'clock my time, and I finish off probably about. I think I'm traveling about this area here, then I could be back at the charts for the rest of it. So it's around that sort of time. Yeah.
Yeah, I would. Yeah, that's another thing is to keep your back testing specific to the time that you will actually be trading, because this pair moves completely different during the Tokyo market than it does London. And again, completely different again in the Sydney session or the New York session. So keeping like accurate timing could be something that, again, you can see the amount of movement that you get here between what's that, 3 o'clock and 4 o'clock compared to the amount of movement that you got between 2 o'clock and 3 o'clock. So that makes a massive difference as well. I would try and what I do is I actually draw on the chart for the block of time that I'm trading. So for me, the London session is 8 a.m. till midday, 12 p.m. I actually just block that time out, and then any entries that are outside of those times aren't valid because you won't be at the chart, you won't be trading it at that point.
Yeah. So for where I am, this is probably the start of the London session. So that's probably 4 o'clock over in Queensland, because I'm in Perth at the moment, right up till 9:30 my time, which is pretty much just after New York Open.
Yeah.
Which is around, yeah.
Yeah. So would you be trading that full session?
Not the full session, no, but I would be watching it periodically through.
Yeah. So you would kind of set alerts.
Yeah, yeah.
Okay. Yeah. Okay. Explain this entry to me here.
Pretty much for me, when it comes, let me just press that a little bit. Once it's come through here, it's come back up, retested it, and since it's already going in that direction and there being a support with the rejection off of that and the strong push down, I've entered to short it into this IDFP, thinking that would make it here and then push back up again. Yeah.
Yep.
So I was willing to come down to this point here and then watch what happens here and then cut the trade off if I needed to, if it was going to pull back the other way.
Yep. What I would say about this is it's not the same entry that you had before. So try and keep your entries like consistent on what you're actually like testing here. You can see that prices move down from that IDFP. Tap in the IDFP, you get a break of structure on the 1 minute and moves down. This is just a kind of like a continuation of structure from here.
Yeah.
very different entry criteria, really. You don't have an IDFP. In fact, you're trading into an IDFP below. You don't have that breaker structure. You've just got the continuation of already existing structure that price has been pushing down for over an hour. At this point, you're just kind of trading alongside it. So I would kind of differentiate like this. To me, that's a completely different trade, which is a completely different strategy. So your backtesting results are going to be kind of skewed from that. Realistically, if you're looking at backtesting a move out of an IDFP today, you got the one at the top, and then that's perfect. You need to wait for the next IDFP really, because that's what you're testing. I think what you're potentially doing here is you're seeing price is moving down, and I can tell by the next position, obviously it says +4 is a little bit of a spoiler. You know where price is going to go, so you're looking for the entry criteria to fit the price rather than looking for the actual position.
Okay, yeah. So in saying that, how long should I be back testing a certain criteria? Say if I was doing a rejection from IDFP, how long do you reckon I should be doing that? Should I be doing it in a month, 2 months, or should I be doing it periodically all the time?
I like to do it at the end of the week. Find as many entries as you can. You can set if you're just going into like doing some heavy back testing, you can set yourself a challenge of finding, say, 25 of these entries, 25 of a break and retest entry, 25 no man's land entries, and kind of record them differently, go into them over different sessions. Try and like look for the specifics, because you know that like even looking at this, that trade from the IDFP, you've had 2 trades in no man's land so far, and you've got 1 trade from an IDFP. Both the no man's land trade have gone -1, and the 1 trade from the IDFP has gone +6. So you kind of need to separate the two into different categories. So I would go out and scout 25 rejection from an IDFP entry, 25 break and retest entry, 25 no man's land entries, and do it that way rather than, say, just looking for every single position that you could have possibly taken in hindsight and kind of adjusting to fit that.
Okay, makes sense. Probably chopping this one, I sort of didn't quite make the halfway points, so pull it up to break even and just out there.
Now this
I'm
one,
not really.
Yeah, let's go through this one. What's the criteria for this?
I don't know. Because this one only just took out this one here. I just took a second entry because it's still slightly rejected from that point there and come back into it.
Yeah,
I thought maybe that.
You're away from the IDFP now. You've had a break of structure to the upside on the 1 minute. Potentially, you could argue by taking out those highs.
Yeah.
You've got a level above you, which is potentially a confluence, but again, it's different to the entry that you took from the IDFP coming down. So again, I take that as a different strategy. So for me, this is kind of like a case of you've seen that price is coming down towards the IDFP, and you've stuck this position on because it ended up going there, and you were kind of looking for that. You were looking for the entry. Realistically, if you saw this on a live market, like if you didn't have any of these previous positions or you didn't have the +4 or anything, and I give you those charts and said, "Are you going to enter a sell right now?" I don't think you would, just because price ends up going down. For me, that's not enough confluence. I certainly wouldn't have entered on that candle, and I don't know if you would have, but for me, that kind of goes against a lot of confluences. Just because price ends up coming down at this point doesn't mean that was necessarily a good entry, and you should be recording it in your backtesting data.
Yeah, which is fair enough as well. Probably is something that I probably should have waited for, because I think it keeps come down to the IDFP and rejected from it.
Yeah. No, I actually think that you had an entry in there.
Yeah.
Yeah. So that one runs +4, but how big's your stop loss there? For it to
18.
Bear in mind, it doesn't go all the way down to the bottom of your position marker there. So you have to bring the bottom part in to where price actually went.
Oh, off where it went to. Yeah, sorry. Yeah, so there.
So like in a live market situation, I realistically don't see the entry there. Yes, it did break down a little bit further and took out some liquidity before the downside, before it went up. But we just talked about before, you had a 4 pip stop loss on the last position. This is a 3 pip stop loss. It kind of looks like the position adjusting because you've got future knowledge. It's hard to really kind of be in the mindset of how am I going to execute this on live? And that's why I like to squash the candles down so you have no idea what's going to happen. Put your replay tool on and go through that. But to me, you actually had a really valid entry on the buy position, which is the exact or a very similar setup to what you had on the sell position that went +6 here from the IDFP.
Yeah.
So if you
Just
scroll a little bit, so we can see both the sell position that you took there that went +6. Yeah. So how would you kind of mark the buy position up from this point?
let me.
Yeah, so you had a nice engulfing candle. I think that's a valid entry as well. If you could get 5 pips up, or you could say standard fall, whatever you're doing. Then.
Yeah. Probably would have went the standard 4 to tell you the truth.
Yeah.
Just so I didn't have to push up so far. Yeah, they probably would have gone +4 there.
Yeah.
And then probably.
And then if it comes down, you go break even.
Yeah.
Yeah. So for me, the key thing there is you've taken two trades in no man's land, which didn't work out. You took the 2 trades from the IDFP, which did work out, and then the trade that you had previously that you've deleted now, that short sell, realistically wouldn't have met your criteria. Your stop loss is different on it. You were kind of fitting the position tool to just prices move down. Whereas where could I have got in here, even if you wouldn't have, right? So with back testing, try and I guess approach it from a scientific point. You're just trying to replicate the same result again. You're seeing price come down on IDFP. You've seen how it reacts. You've seen what candles it gives you. The other important thing that we haven't even really gone into here is what do the higher time frames look like? What does this look like on daily and stuff like that? That's all data to add into your back testing. So now you know that, like looking at these positions, your profitability trading from an IDFP compared to trading in no man's land is way more profitable because this is what you've tested. You've got proof here, you've got the test results. The results are in. This is what it looks like. There's 10 units here compared to what we kind of had previously.
Yeah.
Let's just go through that last position as well and have a look at that. Oh, yeah. There's a few more. Okay, so now we've broken the IDFP.
Yeah, so it's gone to the downside, and then I think I've seen this candle push back through.
Yep.
Something like this, I don't think I would have actually taken, but I've just, because I've seen this very small break of structure here on the 1 minute time frame, and then I've just chucked it on just to, I think it's more to see how it would play out. So let me just.
Did you just put your stop?
Yeah, I think that's 5. Look a little bit bigger if it's going very close.
What would your rule be for making sure that for using the bigger stop loss here?
Just because of where that support line was here, because that was a daily imbalance.
Yeah. Okay. So extending it out a little bit further to encompass a higher level of support. That's fine. As long as you've got a rule for doing it and you're not just doing it for the sake of it.
Yeah. So that's just, I think it was about there. I'll close it up. Come very close and come back through. And that's where it would have taken me out.
Okay, yeah. So let's have a look at this. So you broke through the IDFP to the bottom. So I guess the main question is, do you think the IDFP is still valid from that point?
Once I went through the IDFP, because we've already rejected here, so that was because I've got this. Yeah. So I would have had that like that already, since it's already touched and gone through. Let me know that one there has already been fulfilled, so likelihood it does come through. But when there's been another level or something directly underneath an IDFP, I have noticed that it could, or mostly does, push back up before pushing through. And that's what I was trying to capture, is that move back up before it had got enough momentum to push through.
Yeah, so sometimes you do get a liquidity grab below an IDFP to take you out to the downside before price ends up.
Yeah.
Moving up there. Again, I would probably consider that a different type of entry. So you're not, right now, you're kind of looking at, you entered because you were looking for a rejection from the IDFP, which is why you would be buying from the IDFP. If you were looking for a liquidity grab entry, again, I would put that in its own separate category and back test that. How does price move when it's just taking liquidity and then you get a momentum candle in the opposite direction? Where do you enter there? what can you look at getting nice and early and have like a nice safe stop loss. You may have different criteria for your stop loss for doing that. So again, I would kind of separate that into its own thing, like a liquidity grab entry, in the same way that a no man's land entry is different to a rejection from an IDFP, which again is different to a break and retest from an IDFP as well.
Okay, no problem. That makes a lot of sense.
And again, would you still be monitoring the charts at this time?
Hey, so 6 o'clock, yeah, so it'll be about 6:30 there for me. Yeah.
Yeah. If you still be
So
monitoring that, totally fine. Again, just something else to be aware of is that the time that you back test is very important because price moves really different times.
Yeah. Normally around this time here, like from here, I do my markups. I put my alerts in around here, so when it does reach these areas, so it'll probably be a couple of pips up here, a couple of pips down there, to see where it comes through and hits it, and yeah, try and get onto the charts if I can, if it's at that point of time where I am free and able to.
Okay, yeah, you can trade all day if you wanted to. Like, if that's realistic for you to sit at the charts for 12 hours, you've got 12, you backtest the whole 12 hours and you see how price moves in this session compared to this session. But if you're only at the charts for 2 hours, then you just really should be backtesting those 2 hours because it'll skew your results. You basically want to get every position that you would have taken if it was live, so you know how profitable it is, how consistent it is, and then you can just go and replicate that, because historical data doesn't always indicate what future results are going to be, but at least it will tell you if you would have been profitable for the last month. If you were profitable every day of the last month, the chances are that you're going to be profitable next month as well, or it's very unlikely that you won't be. That's all you're really trying to test. So there's no point me back testing gold at 2 o'clock in the morning to see how that moves, because I'm never going to trade that. Like, I'm never going to do that, and I don't want to do that. So that's kind of important as well. I would say that entry there, that liquidity grab entry, part of the reason why you came up is obviously you took liquidity below the IDFP, but you're also massively overextended on your high time frames. So that buy position actually goes against your higher time frames, which is something to take into consideration. You don't always have to trade with the higher time frames, but personally, through my back testing and the way that I enter, I find that I'm more profitable waiting for trades that line up. My personal entry method and how I back test and how I found my edge is I like multiple time frames to line up. I'm very conscious of what the 1 hour and 2 hour is telling me, and I'll actually skip positions that I think might be profitable and might work out if it doesn't line up with my longer time frames, because I know that's my rules. That's what's proven to be profitable for me. You don't have to trade exactly the same as me. You don't have to trade the exact same Jay or Liam or any other trader out there. You will find your own edge, your own way of doing it. You just kind of have to test that. So that's the only way.
Yeah.
Okay. So I think we've seen enough positions there to have a little look at a couple of things that might be kind of giving you discrepancies between your back testing and your live trading results. The first thing I would do would be to find one type of method that you'd like do backtest all the methods of entry. So liquidity grabs, IDFPs, rejections, break and retest, no man's land trading, how price moves from market, higher time for market imbalances. Backtest them all, and then start adding variables in. Okay, so I know I'm most profitable when I trade from IDFPs, rejections from IDFPs. If that's the only way that you're profitable trading, that's the only trade that you should be taking until you start adding variables in. Okay, I'm profitable trading from IDFPs. Now I'm going to add in trading in no man's land. Now I'm going to add in trading from liquidity grabs, and kind of add those variables in, test them, see if you're more profitable doing that. But you might be profitable trading IDFPs, and then you start to add in different types of entry and your profitability goes down. If that's the case, just trade from the IDFPs. Even if you take 3 trades a week, if you make, I don't know, let's say 10 units, you take a +6, +4, and a break even, but there's only 3 positions presented to you every week. That's still 10% a week. That's still 40% in a month. You just need to find that edge and keep it. And then once you've got that edge, you can sharpen it by adding in no man's land trading, stuff like that. So separate everything out into its individual variables, test all the variables separately, and keep it conducive to real market conditions. if I'm not trading after 8 o'clock, I'm not going to backtest any positions after 8 o'clock because I won't be trading, so it's irrelevant. It's just going to skew my result. Making sure that you don't have that unconscious bias as well. Flatten your candles down. Make sure you're not putting positions on the chart just because they end up being profitable and you're actually looking for the entry criteria. The criteria is more important than the result, because you backtesting a move down, like, it's pretty pointless. Seeing the price coming down and then putting a position tool on there and say, oh, I would have taken that when you actually wouldn't have. You're just kind of doing it to, I guess, make yourself feel better about it. But that's kind of would be my advice for this lines, would be to pick an entry style, backtest it 20, 30, 40, 50, 100 times until you're sick of seeing it. Pick another entry style, backtest that one that many times, and kind of add things in. To be honest, it's most profitable trading from IDFP. Anybody who's not profitable yet, I'd say just wait for your IDFPs. That's how I did it. That's how Liam did it. That's how Jay did it. Go back and have a look at the very first daily recaps that we did in 2020, I think. Very, very late on 2020, like October time. You'll see that Jay doesn't take any trades that aren't from IDFPs. That's exactly. Find that profitable edge first, even if you're trading less, and then add in the extras.
Yeah.
Okay, mate.
No issue. Yeah.
What we'll do is we'll check in again next week if you've got time. I'll have a look at some of your backtesting data from this week coming. I want you to pick one entry style, backtest that, give me your results, and then we'll forward test it in the next live session. So we might have a couple of these. I'll record them, and again, we can share the progress.
Okay, no problem.
Awesome stuff. All right, thank you very much, Lance.